In this video, we'll walk through creating a data table in valuing a stock, a very powerful tool because when we value a stock, we want to consider the concept of a margin of safety, which is what is the range of stock prices we could be comfortable with this company, and see how much we could lose, how much we could gain with the company. So a data table is very powerful. In this case, the problem is AllState. We know AllState is an insurance company. We're going to create their valuation using the dividend discount model and the H model, but then we're going to create a data table on the dividend discount model. Here are the assumptions: the 10-year treasury, inflation we don't need in this problem. The beta, we're going to start with 1.1, but we're going to do analysis of 0.9 to 1.25. The equity risk premium is given. The dividends for next year, that's important, not last year, but next year, is 84 cents. And the long-term growth rate is 5.5%. We're going to look at a range of 4.5% to 6%. Their management expects earnings growth 10% for the next year, and then over the next 10 years it will move from 10% down to 5.5%. So that gives us all the information we need. So we bring that in to our assumptions. We see that the dividend 1, that's next year dividends, 84 cents. The risk-free rate is 2.5% that we got from the 10-year treasury. The equity risk premium is 4.5%. Again, that was given in the problem. The beta, starting beta 1.1, was given in the problem. We're going to run scenarios on that. The discount rate using the capital asset pricing model, so KE equals the risk-free rate plus beta times the equity risk premium. So in this case, we have 2.5% plus 1.5 times 4.5%. That gives us a discount rate of 7.45%. Our long-term growth was given. That's the long-term nominal growth of GDP. We're assuming AllState's going to grow in line with the U.S. economy. Short-term growth is 10%. That's given in this last sentence, that their growth is expected to be 10% next year. And then moving down to long-term growth over the next 10 years, the H is 1/2 of that period of time. So if it takes 10 years, you use 5 as your H. So then we do the valuation. So the valuation for the constant growth model is dividend 1 divided by KE minus G. So in this case, dividend 1 is 84 cents. 84 cents divided by 7.45% minus 5.5% gives you a valuation of $43.08. The H model, a little more complicated. You use dividend 1 plus dividend 1 times H times growth short term minus growth long term divided by KE minus K minus growth long term. If you have dividend 0, you do have to adjust dividend 0 and multiply by 1 plus G. So there's our H model valuation, $52.77. The current price is $44.91. So we are going to create a data table. To do the data table, we need to replicate that $43.08, but we need to have the entire formula, including the entire formula for the discount rate. So we're going to take dividend 1, the 84 cents, divided, and here we're not going to click on the discount rate. We're actually going to do the entire equation, 2.5% plus beta times the market risk premium minus our long-term growth rate, and we should get the exact same answer we got before, $43.08. Sure enough, we did. So now we're going to create a data table. So we're going to have betas going across the side, and we're going to have long-term growth going down the column. So our betas, we want our highest beta first. So we said in the instructions that we wanted betas to go from 0.9 to 1.25 in increments of 0.5. So we'll start with 1.25, and we'll reduce that by 0.05, We'll copy that over until we get down to 0.9. I'm going to change it to comma so I can have 2 decimal places. And then on the growth, the long-term growth, we said we want to do a range of 4.5% to 6% in increments of 0.25. So we'll start with 0.045 and we will increase that by 0.0025. I'm going to change those 2% with 2 decimal places and I copy that down until we get to 6%. Went a little bit too far. So 6%. So now we have everything we need. This is for the data tables. So you click on that formula and you go down the page and you go across. So you highlight that entire data page and then you do data, what if analysis, data table. For the data table, it says where in this formula, which row value do you want to alter? And the row value we want to alter is beta. So we want to make sure we click on the beta cell. And the column we want to alter is long-term growth. So we click OK. And that will create a data table for us. We can highlight that and put it formatted in dollars. Our assumption was a beta of 1.1 and a growth rate of 5.5. So there's our 4308 right there in the middle. What I'm going to do is I'm going to highlight the column and make it bold, change it to blue, and use a white font. And then same thing with the column, bold, blue, and white. I'm then going to actually hide this price because we don't want that in our column, so I'm going to make that the same dark blue so it hides it. And then I'm going to do one last thing. Oops, I missed one. So we want to highlight this entire thing and then we want to do conditional formatting. If our valuation is greater than the current price, that means we think the stock is cheap, we want to highlight it as green. If, do conditional format again, if our valuation is less than the current price, we want to highlight that in red. What that means is if we think AllState's worth $23.17, but it's currently trading for $44, we think it's expensive. That's why that's in red. Down here, if we think AllState's worth $67, but they're currently trading for $44, that means we have it in green because we think it is a good buy, it's a good stock. And so this data table can be used as in essence a margin of safety. How bad could it be? How good could it be? It gives you a range. You might mark a section in the middle which shows maybe your range that you think is most likely. I might say 5 to 5.5% growth is what I really think is true, and beta to 1 to 1.5 is really what I think is true. So I could actually format that cell and go to the border and do a thick outline and say, okay, here's what I really believe in this section, but I get an entire view of the stock with various assumptions. So in just very quickly, we have a really good analysis of the potential upside and downside of our stock. Thanks.